Good morning, traders. Here's your latest market update for today. Starting with the US dollar index, at the start of the week, the markets showed a rebound in risk appetite, keeping the US dollar index in a narrow range below 100. Risk sensitive currencies such as Australian dollar strengthened, while safe haven like Japanese yen weakened, helped by the optimism that the US Senate could soon end the 40-day government shutdown. The hopes of renewed fiscal spending and political stability ahead of the next year's election lift the global sentiment. And meanwhile, traders are digesting mixed policy signals from global central banks. The market now sees a 61% chance of a Fed cut in December, but expectations could shift sharply after this week's employment data. Several Fed officials expressed agreement over further easing, underscoring the policy divide facing Chair Powell. And technically, the DXY advance remains limited between 99.5 to 99.7, showing mild downside bias. The MACD remains below zero with no bullish crossover, and 14-day RSI around 55 signals a weak rebound. The index failed to sustain above the 100 psychological mark and the 200-day SMA at 100.17, confirming resistance near that area. The current level is 99.65 with resistance at 100, while the support sits at 99.28. So moving to WTI crude oil, the oil prices traded slightly above $60 per barrel as supply and demand factors are balanced early in the week. And tight refined product supply supported the prices, but ongoing concerns about oversupply kept the gains. Risk sentiment improved after the Senate advanced a deal to reopen the government, boosting hopes for stronger energy demand from renewed federal spending. But still, optimism remains very cautious as the shutdown caused disruptions, including 2,800 flight cancellations, weighing on the jet fuel demand. And technically, crude oil remains range bound between 61.45 and 58.75. The 50-day, 5-day moving average near 61.45 act as a strong resistance, and a breakout could open the way to 62.38. But conversely, a drop below $59 could trigger another leg down to 58. Until either boundary is broken, consolidation is expected. So traders should remain flexible while tracking the shutdown at deployments, at developments, and also the inventory data. Next, spot gold. Gold traded near $41.30 per ounce, up over 3.3% in the first half of the week to its highest close in 2 weeks. A rising rate cut expectations supported gold as weak US data last week undermined the confidence in economic strength. Despite improved risk sentiment, investors kept buying gold, viewing lingering shutdown effects and also mixed labor data as the reasons for further Fed easing. The analysts also see potential for gold to reach 4,200 to 4,300 by year end, with $5,000 a possible target in early 2026. And technically, gold broke above the Bollinger midline at 4082 and also the 4100 barrier, confirming the strong bullish momentum. The MACD lines are above zero with expanding histogram bars supporting upside momentum. A key support lie at 4082 and 4020, while the resistance is seen at 4149 and also 4200. And last but not least, the Australian dollar. The Aussie dollar dipped after 2 days of gains, falling below 65 cents before recovering. Support came from upbeat Westpac consumer confidence, which jumped 12.8% in November to 103.8, and NAB business conditions improving to 9. RBA Deputy Governor Andrew Hauser reiterated that the policy must stay tight to control the inflation, saying Australia's economy still faces capacity constraints and also limited scope for near-term easing. And technically, Australian dollar remains sideways above 65 cents, trading above the 9-day SMA at 65.17, indicating the firm short-term momentum. Immediate resistance lies at 65.80, so a breakout could lift the pair to 66 cents. Support sits at 65 cents, followed by the 200-day SMA at 64.52. So that wraps up today's morning review. Watch for the US labor data and shutdown updates. Both could shift sentiment sharply across the forex and also commodities. Trade safe, and I will see you tomorrow.